This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Larry back on the show. Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoice.com, and click on the red button over Larry's picture saying looking for the downloads. Okay, Eric, let's start talking about equities here.
Well, Patrick, I won't be surprised if this rally continues, I don't know, maybe all the way up to 6,500. But I'm already selling into it. Or more accurately, I should say, I've begun to accumulate put spreads on E-mini S&P futures struck between 57.50 and 47.50, so a 1,000-point spread to hedge the possibility of another round of drama between President Trump and Secretary Bessent in the third quarter.
Well, Eric, what scenario would 6,500 happen? In my mind, that would be a reaction to some very positive headlines that would be coming out around the July 9th when we have the tariff deadline. If Trump has been working in the background with getting a whole bunch of deals done, maybe some super exciting headlines about the tariff wars being over might spur an impulse of buying in the markets, feeling like all of this is now behind us. That could be that kind of momentum. Now, purely on technicals, the market is very distinctly in a bull trend, higher highs. Now that we've surpassed all of the previous highs, that it no longer acts as technical resistance. And so the markets have a lot of free reign. At the same time, a number of measured moves are done. We're 300 S&P points above the 50-day moving average. So when you go back through the history of market rallies, when we're this stretched off of an average line, it tends to be the upper boundary of bullish moves. That doesn't make it bearish. It simply means that often the market pauses and consolidates as the market has kind of stretched too far and then mean reverts or consolidates the run. And so there's a lot of reasons to actually technically envision a pause in this advance. What could cause a pause in the market? Well, one distinct thing is on page 3 is we saw a very interesting July 1st trend, which is that the momentum value ratio broke down. There was selling in the most popular kind of AI names starting on July 1st and a very interesting breakout in a lot of value names. And so why July 1st? Well, that's the end of the second half of the year and the end of the quarter. So there's substantial fund and asset manager quarterly rebalancings going on. And so the question is, did we see a pivot in these trends as there's a new reallocation of capital coming where they start taking off some of these very bullish semiconductor names and other AI names that have had this huge run, and they rotate that out into more defensive spaces. We saw big breakouts recently everywhere from healthcare to consumer staples to the home builders to a whole array of beaten down and left behind commodity names, some of which Larry was referencing throughout the interview. And so with these kind of upticks, if we see that sector rotation is the name of the game, then it's not necessarily that something bearish has to happen, but rather if the big mega cap, market cap names see a little bit of profit taking in this sector rotation, then we could have bull markets running just in other parts of the market while the stock market starts to get a little bit heavy up here. At this stage, for there to be a bearish breakdown in the month of July, I think it needs a meaningful catalyst. And as far as I'm concerned, if we get past these jobs numbers and past the July 9th, which without it causing some sort of big event, then the only real thing that could crack the markets here in July will be the earnings, which will be past the July option expiration. And so at this stage, I think the markets are going to be a little bit more choppy here, but there is opportunity, and therefore it's just about identifying where those opportunities are going to emerge. Let's move on to the dollar. What's your thinking here?
Well, the selling continues this week, very briefly testing a 95 handle on the Dixie before a bounce began. My downside target for this move, Patrick, is 89. Yes, 89. That's another, 6 big handles down. But I'll be very, very surprised if we get there without at least one and probably two significant counter-trend rallies, which could come at any time, including tomorrow or next week.
Well, I don't know if I'm as bearish as an 89 handle on the downside, but what we do have is a scenario where the prevailing downtrend is dominant and every bounce is almost immediately sold in this prevailing downtrend. And so with this downtrend still in place, then the most immediate downside measured move is that 95 level you were suggesting. That is in line there. But at the same time, this is an incredibly crowded trade with the sentiment of almost all investors being so decisively in consensus of a bearish dollar. This allows there to be, something that squeezes all of them out, the dollar shorts out of it with a violent rally. When we were calling that on oil, it just so happened to be a Middle Eastern confrontation that ultimately was the catalyst. But a catalyst always emerges. And if this trade continues to be as crowded as it is, even though the primary downtrend of the dollar may stay intact over the remainder of the year, there's definitely increasing probability that some sort of a counter trend squeeze can emerge here in the months to come. And will it be, something like the resolution of the tariffs or something like that creates a little bit of a relief rally? We'll see. All right, Eric, let's touch on oil.
Well, Patrick, so far my second chance hypothesis that I described last week, suggesting that maybe we're getting a second chance to buy a really good opportunity to get on this upside move before it really gets underway. So far, it's playing out, but we're only a week into this. Let's wait and see what happens. Meanwhile, what are the charts telling you after absorbing last week's whipsaw?
Well, Eric, my thesis on oil is that I just don't think that conditions are bearish enough and the geopolitical circumstances aren't resolved enough for us to have a new bear decline where we go back to $55 or lower on crude. And so to me, while I don't have necessarily a strong bullish thesis that we're going to like $90+ on the upside, I do think that we are on the lower boundary of what's going to be a new trade range. I marked off on the chart on page 5 what was the 6-7 month trade range from basically September of last year all the way through March, which was this range between like $67-68 all the way up to about $72. And I think that that's a very interesting position to be taking here, is that the oil will come back into this trade range and stay up at these more elevated levels. This will be meaningful because that will start turning all of the technicals up for oil off of their worst levels as we're off of those April-May lows. And it'll be interesting to see whether that's enough tailwind to really start turning many of the energy equities that have been really left behind in this entire bull phase, and whether they actually start behaving and creating a new bullish opportunities. All right, Eric, on page 6, we have that chart of gold. What are your thoughts?
Well, it seems clear that the short-term swing low is in, with both the slow stochastics and the RSI pointed back up again after they both bottomed in extreme oversold territory earlier this week. Now, I guessed that this correction might bottom on I think I said a high 32 handle, maybe 32.90 or so in last week's podcast. Okay, it turned out it was about $40 lower, just over 32.50. So close, but not quite. Of course, another wave down is still possible, but I think a rally from here to new all-time highs is actually more likely. We needed that $250 correction to shake off the unwind of geopolitical risk hedging hedges. Now, frankly, I scratch my head trying to understand why the people who unwound those hedges think the risk is fully abated, but the point is a certain number of people were going to unwind their hedges. Those people have now unwound their hedges as a result of Trump declaring total victory in the nuclear facility strikes, and I guess the people unwinding the hedges bought that story. Those hedges are now out of the system. That paves a clear path for us now to move higher, which is where I think the fundamentals are taking us, probably toward a new all-time high. So hopefully I haven't jinxed the market and it won't have reduced to the point where you see a print below 3250 by the time this podcast airs. But as I'm recording, it's still looking well above 3350, 360 something as I look over my shoulder at the chart here, and I think we're headed maybe back above 3,500. Let's see what happens.
Well, Eric, I bought the dip around the 3,300 level where that 50-day moving average was, and looking to see whether or not the bulls can follow through. I have this at least from a tactical short-term basis on a short leash, because when you have a reversal like this on the upside, it needs follow through. And as far as I'm concerned, one of the most important things the bulls will need to do next week is to clear 3,400 on the upside to prove that this was a buy on dip and this is a continuation pattern for another bull trend. I continue to think it's actually super easy to trade here because we're trading right at that 50-day moving average, which has basically been a very good depictor of the primary trend that's been in place for over a year. And so the way I look at it is that either A, we're going to clear 3,400, which then puts 3,700 in play, or that fails to follow through and gravitates back down below to or below that 50-day moving average. That would be a short-term indication of weakness, and that would make me question whether or not some sort of topping formation could be underway. But I'm giving the bulls the benefit of the doubt now. Let's see whether they can follow through on the upside. Now, Eric, on page 7, I have that chart of the spot physical uranium. So spot prices of uranium have certainly started to advance here in the last little bit. What are your thoughts here?
Well, as mentioned in the feature interview, while I still hope for a meaningful correction or pullback, I'm rapidly losing faith in that actually happening. The problem is there's a line of just way too many people all waiting to buy the dip. I think there's just a whole lot of people, myself included, who were watching this market saying, okay, I've got my position on, but I don't want to go all the way into my full position until I'm sure that this crazy bear market that we just went through is really and truly over. All of a sudden, prices have doubled. Oh, wait, but there's got to be a pullback. There's got to be a pullback. Yeah, there ought to be a pullback according to normal analysis. But with this many people expecting it, it's almost certain that those dips are going to be bought sooner than later, and they're not going to dip as far. So I think the gaps below the market are not likely to be filled before Labor Day, as I was hoping for, unless there's some big external bearish catalyst that drives it, some event, either broad market risk or some, nuclear plant disaster or something happens. I'm starting to nibble already this week up here at these prices. It's painful because we've come so far up, to be adding more here. I want to wait for that pullback, but I'm just not convinced it's going to happen. August 15th is going to be my deadline to have a full position on. If we get through the end of, it's already first week of July. If we get into late July, I'll probably have to start averaging in if we haven't had any buyable dips between now and then. So I'm hoping for downside before the upside, only because I'm so convinced the upside is coming that I want to put more size on this trade if I possibly can. I will say I'm starting to think more about a downside risk we haven't talked about on MacroVoices before. Nobody's talking about it, frankly. And that is, I believe, and this is purely 100% personal, subjective, personal opinion here, I think the risk of somebody detonating at least a tactical nuclear weapon in one of these 3 or 4 active war theaters that we have going on around the world in the next couple of years has reached at least a 50-50. I'm not saying it's going to happen. It's not a prediction, but I think we're at about a 50-50 that somebody is going to escalate to detonating a tactical nuke. What, if anything, does that mean for investor sentiment around civilian nuclear energy? Well, the only data point that exists for somebody actually detonating a nuclear weapon in warfare is from 1945. That one data point isn't really similar to the current situation, or at least I sure as hell hope not. So if somebody uses a tactical nuke out in the middle of the ocean someplace in a conflict, does that cause everybody to freak out about nuclear energy, or do they not even associate it? I have no idea. I don't think anybody does. We know that accidents at nuclear plants like Fukushima and 3 Mile Island certainly freak out investor sentiment. Will a nuclear weapon detonation cause a big freakout? I'll tell you, if it caused a big freakout right now, I would look at it as an incredible buyable dip opportunity. I think it could be a very, very big dip. I think people could get very emotional if that were to happen, but I don't think it really sanely matters to the future of nuclear energy, and I think we need nuclear energy badly enough that we would come to our senses. That event might take several months to a year to blow over, but I think it would be an incredible buy the dip if it happens. So we'll see. It's obviously an outlier, but I do think it's possible.
Well, Eric, I have two very distinct opinions. First of all, I think there's the uranium equities, and then there's the actual spot prices of uranium. The uranium equities have had an extraordinary run, and I know that you and Larry just had that conversation about them being a little stretched on the upside. I'm in principle in agreement there, where this move has really advanced on these equities, and it's not that it can't continue. It's not like Cameco can't hit 80 or higher. It's just simply that the asymmetry of the staying in the trade is diminishing, because a stock that has moved as extraordinarily high as Cameco has up until this stage is vulnerable for a $10+ correction on the downside at some point. And so the question is, can you get at least $10 more on the upside? And as the payoff is kind of neutralizing, there's an increased benefit of using things like option strategies such as collars to lock in these upper gains, because I continue to think it's far more neutral here, where the downside risk is about the same size as the upside potential, and this is the perfect condition from which to implement strategies like that. When it comes to the spot physical, though, it really feels like this year-long bear market is over. With this kind of a bull breakout, while there will be dips, I think that spot prices of uranium have not had this kind of big run on the upside the way the equities and the enthusiasm in the equities were. I'm far more bullish on the physical uranium trusts than I am on the actual equities.
And Patrick, before we wrap the show, let's hit that 10-year Treasury note chart once again.
Well, it's been a trade range for the last 6 months in the 10-year Treasury yield. Bonds have been quiet, has contributed to why equities, I think, were able to really run, because there's been no disruptions from the bond markets. The big question is, as we get to the passing of the big beautiful bill and we get to the necessary Treasury issuances that the government has to make, will we see the Treasury bond markets wake up and start creating a little bit of trouble? And will that be where equities will start to care at some point? At this stage, this is a very quiet market. Not necessarily predicting something is imminent, but this trade range really makes this a quiet market and no real big activity there. But on page 9, I want to highlight that 3-month SOFR future, again focusing on the December 2026 to encompass about 18 months of interest rate policy. We continue to actually edge higher, as the question becomes, will the Fed inevitably have to ease up on their rates and become more dovish at some stage? I could think there's all sorts of things that can happen that will essentially force the central banks to be far more accommodating than they're currently positioned for, and therefore I remain quite bullish on these SOFR futures and think that there's room for this to break out of this trade range that's been established over the last 2 years.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.